Right now, thousands of Australian retirees are quietly losing part of their age pension every single fortnight, and most of them have no idea why it is happening. The culprit is not bad investments, not a government error, and not bad luck. It is superannuation. The very money you spent decades building up to enjoy in retirement could be the exact reason Centrelink is reducing your pension payments today. And here is the part that shocks most people. Your super does not even need to be withdrawn. It does not need to be spent or touched in any way. The moment you turn 67, Centrelink can still count every dollar of it against you. If you are approaching pension age or already receiving payments, the next few minutes could genuinely save you thousands of dollars every single year. Do not skip a second of this. Welcome to the channel, and thank you so much for being here today. This channel exists for one reason only: to give everyday Australians clear, honest, and practical information about the age pension, superannuation, and everything Centrelink does not always explain in plain language. Today, we are tackling one of the most searched and most misunderstood topics in retirement planning for 2026, exactly how much superannuation you can hold before it starts eating into your age pension. We are going to walk through the real numbers, the hidden traps that catch people off guard every single year, and a handful of simple steps you can take right now to protect what you have spent a lifetime building. Everything in this video is based on the most current 2026 figures, researched carefully so you can rely on it. Let us get into it. Let's start at the beginning, because this is where most of the confusion lives. Superannuation and the age pension are not opposites. They are not designed to cancel each other out. In fact, the vast majority of Australian retirees receive both at the same time, a regular income stream from their super combined with either a part or full age pension from Centrelink. That combination is completely normal and entirely legal. But here is where things get complicated. Before you reach age pension age, which currently sits at 67, your super in accumulation phase is essentially invisible to Centrelink. They do not count it, they do not assess it, and it does not affect your payments in any way. The same applies to your partner's super, as long as they are also under 67. The very day you turn 67, that invisibility disappears completely. From that moment forward, your entire superannuation balance becomes what Centrelink formally calls an accessible asset. It does not matter whether you have started drawing from it or whether it is still sitting untouched in your fund. Centrelink counts it either way, and it will be assessed against both the assets test and the income test. There is one detail here that catches couples completely off guard, so listen carefully. Imagine a husband who is 68 and already retired, and his wife who is 63 and still has her superannuation sitting in accumulation phase. While she remains under 67, her super balance is invisible to Centrelink. But the day she turns 67, that balance suddenly appears in their combined asset calculation. If it pushes their total assets over the relevant threshold, their pension can drop, sometimes quite significantly and seemingly out of nowhere. If you are part of a couple with any kind of age gap between you, this is something worth planning for well in advance, not scrambling to address after the fact. Now let us look at the actual numbers, because this is what most people watching this really came here for. Centrelink runs two separate tests to determine your pension entitlement. The first is the assets test. The second is the income test. Centrelink applies both tests to your situation and then pays you whichever one produces the lower pension result. That is important to understand, because passing one test comfortably does not guarantee you pass the other. Starting with the assets test, since superannuation lands squarely in the middle of it. As of July 2026, a single person who owns their home can hold up to approximately $333,000 in total accessible assets and still receive the full age pension. For a couple who own their home, that combined figure sits at around $499,000. Once your assets exceed those thresholds, your pension does not vanish overnight. It reduces gradually, with your fortnightly pension decreasing by $3 for every additional $1,000 of assets above the threshold. This is a slow decline, not a sudden cliff edge, and that is actually good news. A common misconception is that going even slightly over the limit wipes out your entire pension. That is simply not true. The reduction is gradual and proportional. The point where your pension cuts off entirely is a different number altogether. For a single homeowner, the full cutoff sits at approximately $722,000 in total accessible assets. For a couple who own their home, that combined cutoff is around $1,085,000. If you do not own your home, both of those thresholds are higher because Centrelink acknowledges that non-homeowners do not have the financial benefit of an exempt family home working in their favor. And that brings us to one of the most important rules in this entire system. Your family home does not count in the assets test at all. You could live in a property worth $2 million or more, and Centrelink will not include a single dollar of it in this calculation. But your superannuation, once you have passed age pension age, absolutely does count. So does cash in the bank, shares, managed funds, investment properties, the estimated value of your car, and even household furniture and personal effects. Take a moment and honestly add up your bank balances, your shares, your super, and anything else you own apart from your family home. Where does that number actually land? That calculation is worth doing today because a letter from
Centrelink should not be the thing that surprises you. Now, let us talk about the income test, because this is where superannuation gets particularly interesting and honestly a little counterintuitive. You might reasonably assume that Centrelink would simply look at how much income your superannuation account actually generates each year and assess that figure, but that is not how it works. Instead, Centrelink applies a system called deeming. Deeming means Centrelink assumes your financial assets are earning a set rate of return, regardless of what they are actually earning in reality. Under the current 2026 deeming rates, the first approximately $64,000 of a single person's financial assets is deemed to earn 1.25% per year. Everything above that amount is deemed to earn 3.25%. For couples, the lower deeming threshold applies to the first $106,000 combined. Here's the part that genuinely surprises many retirees. If your superannuation account-based pension is actually performing well and earning 6 or 7% in a strong investment year, Centrelink does not care. They still apply those fixed deeming rates. In a poor investment year, this can actually work in your favor because Centrelink might assess you as earning more than you actually are, and your pension may be higher than you expect. But in a strong year, the reverse can apply, and your situation may be reassessed upward. This is why a number of retirees get an unexpected shock when Centrelink reviews their circumstances and their pension suddenly adjusts downward. If your super has grown noticeably over the past 12 months, it is genuinely worth checking in with Centrelink or a financial advisor before they check in with you. Before we move on, there is something else worth knowing if you are still doing some paid work after turning 67. Many people over pension age believe they need to stop working entirely in order to receive any pension at all. That is not true. There is a
provision called the work bonus, which allows pension recipients to earn a certain amount from employment before it affects their pension under the income test. This has made a significant difference for older Australians who want to ease into retirement gradually rather than stopping all at once. If you are still doing casual shifts, consulting work, or part-time employment, this is absolutely worth understanding properly. Now, let us talk about the mistakes that cost retirees money year after year, because knowing the rules is only half the battle. The first trap is gifting. Some people believe that giving money to their children or grandchildren will reduce their assessable assets and therefore increase their pension. Centrelink is very familiar with this approach, and the rules around it are strict. If you gift more than the allowed amount within a 5-year period, Centrelink will continue to count that money as if you still own it for 5 full years. Attempting to gift your way to a higher pension can leave you significantly worse off, with reduced assets and no additional pension to compensate. The second trap is downsizing. Selling the family home seems straightforward, but if the proceeds are not reinvested into another property reasonably quickly, that cash immediately becomes an assessable asset. Retirees who have sold their family home expecting a pension boost have instead watched their payments drop because the sale proceeds pushed them over the asset threshold they were comfortably sitting beneath. The timing and reinvestment of that money matters enormously. Here is something worth sitting with for a moment. 2 people could have the exact same superannuation balance and receive completely different age pension entitlements simply because one of them owns their home and the other does not. That single factor carries extraordinary weight in these calculations. So what are the practical steps you should actually take based on everything covered
today? First, calculate your current total accessible assets as accurately as you can. Include your superannuation, bank accounts, shares, investment properties, and other accessible items. Then compare that honestly against today's thresholds. Knowing where you stand is the foundation of everything else. Second, if you are part of a couple and there is an age gap between you, map out the timeline for when the younger partner will turn 67. That birthday can change your combined pension entitlement overnight, and planning for it well in advance gives you genuine options. Third, remember that these thresholds are not permanent. They are indexed and adjusted by Centrelink twice a year, in March and in September, based on changes in the cost of living. The numbers that apply today may shift again in just a few months, so staying informed is not a one-time exercise. Finally, if your situation is at all close to any of these thresholds, or if you have a complicated asset mix, it is genuinely worth booking a free appointment with Centrelink's Financial Information Service or speaking with a licensed financial advisor who specializes in retirement and pension planning. One well-informed conversation now could protect thousands of dollars a year for the rest of your retirement. That is not an exaggeration. It is simply the reality of how these rules work. Every number and rule covered in this video reflects the most current 2026 information available, researched carefully so you can rely on it. But these rules do change, and your personal situation is unique. Always confirm your specific circumstances directly with Centrelink before making any significant financial decisions. If this video helped make things clearer for you today, please give it a like. It costs you nothing, and it helps this content reach other Australians who genuinely need this information. Subscribe so you never miss a new video, because new content goes up regularly covering everything that is
Changing with pensions, super, and your entitlements, all in plain and simple language. Drop a comment below and let us know your situation, whether you are a homeowner, roughly what age you are, or what questions you still have. Every comment gets read, and your questions directly shape what gets covered next. Coming up very soon, we are going to break down exactly how much you can earn from part-time or casual work in retirement without it affecting your age pension at all. That one is not to be missed. Take care of yourselves, stay informed, and we will